this lecture, we are going to be covering cost of capital. However, before we get onto the calculation of cost of capital, we need to cover a few other important principles first. The first important principle that we need to look at is the relationship between risk and return. Now guys, obviously when shareholders buy shares in a company, they are going to be exposed to risk. And the return that they are going to require on their investment is going to depend on the level of risk that they are exposed to. If we are dealing with a rational investor, and we always assume that our investors are rational, a rational investor would expect a higher return on a high risk investment. So guys, people don't just take risk for the sake of taking risk. If you take a risk, it's because you expect to be compensated for that risk with a higher return. So that's the relationship between risk and return. If something is very risky, you would expect a higher return on your investment. If it's very low risk, you'd be happier to accept a lower return. So when shareholders buy shares in a company, the return that they require on their investment is going to depend on the amount of business risk that they're exposed to, as well as the amount of financial risk that they are exposed to. Now, business risk relates to the day-to-day operating activities of the company, and financial risk relates to the level of debt within a company. So if we are dealing with a company that has very high risk day-to-day operating activities and they have a lot of debt in their capital structure, then shareholders are going to require a higher return on the investment in order to compensate them for that business risk and financial risk. On the other hand, if we are dealing with a company that is not very risky, so their business risk is very low, their day-to-day operating activities are not very risky, and if they don't have a lot of debt in their capital structure, they'll also be less risky, then shareholders will be prepared to accept a lower return on their investment. But it's important to note, when we are trying to determine the return that shareholders require on their investment, we need to take both business and financial risk into account. And please just note, the shareholder's required rate of return is if we are looking at it from the perspective of the shareholder. So the shareholder is going to want a specific return on their investment. So let's say, for example, the shareholder wants a return of 10% on their investment. If we look at this from the company's perspective, that is the cost of equity for the company. If the shareholder expects a return of 10%, the company is going to have to pay a 10% return. So it's the cost of equity for the company. So it actually just depends on whose perspective you're looking at it from. The terminology changes. If it's from the company's perspective, it's the cost of equity. If it's from the shareholder's perspective, it's their required rate of return. Now guys, it's very important that you are able to calculate and interpret the following capital structure ratios. So what do these ratios tell us? Now, your capital structure is just the mix of debt and equity in financing the assets of the company. So in other words, are the assets financed 50% debt, 50% equity, or is it 60% equity, 40% debt, etc.? That is what these capital structure ratios tell us, the amount of debt that a company has in its capital structure. So it's obviously very important because it gives us an indication of the level of financial risk. If a company has a lot of debt in their capital structure, financial risk will then be higher. So you need to know how to calculate these ratios. You need to know how to interpret these ratios because they are indicators of financial risk. They tell us how much debt a company has in their capital structure. So guys, please refer to the lecture examples for this section. Make sure that you work through all of the lecture examples. They are very simple lecture examples, but most students do struggle with the theory or the understanding behind these lecture examples. So it is important that you please do work through those lecture examples and make sure that you understand how these capital structure ratios are calculated. Make sure that you can interpret the ratios in order to determine how much debt a company has in their capital structure. Then you'll see after all of the lecture examples, I just pull out the most important principles that are covered in those lecture examples. So you'll see when working through the lecture examples, all of the ratios should be calculated using market values and not book values. So you use the market value of debt and the market value of equity in these ratio calculations above. When you calculate the debt to equity ratio and the gearing ratio, you must use market values. And then in addition to that, you'll see when you work through the examples, the debt to equity ratio does not always give you the capital structure of the company. So it's often necessary to take the debt to equity ratio and convert it into a gearing ratio. Now, obviously, guys, if you don't know what I'm talking about, then you have to refer to these lecture examples over here. All right, so go work through those lecture examples. Make sure that you are happy with both of these calculations over here and you are happy with these important principles. All right, we are now going to look at the advantages and disadvantages of debt. So let's first focus on the advantages of debt. Why do companies want to have debt in their capital structure? And the reason for this is because the cost of debt is lower than the cost of equity. Or in other words, debt is cheaper than equity. Now, debt is cheaper than equity for two reasons. First, debt is cheaper than equity because the providers of debt capital are prepared to accept a lower return on their investment because they are exposed to less risk. So, a bank that gives a company a loan is exposed to less risk than a shareholder who buys shares in a company. And because the bank is exposed to less risk, we already covered the relationship between risk and return. If you are exposed to less risk, you'll be prepared to accept a lower return on your investment. And that makes debt cheaper than equity. So why are the providers of debt capital exposed to less risk than providers of equity capital? Well, firstly, when it comes to debt, interest and capital payments must be paid regardless of financial performance. So even if the company has a bad year, they still need to meet the commitments on the loan. If interest is payable or if capital is payable on the loan, they have to make those payments. There's no choice. On the other hand, if the company has a bad year, they don't have to pay dividends to shareholders. So shareholders are exposed to more risk. They won't necessarily get a dividend every year. Whereas debt providers know that they will get their money, obviously unless something goes completely wrong, but they should get their money every year. So because they are exposed to less risk, they will accept a lower return on their investment. Or on the other hand, because shareholders are exposed to a higher risk, they would expect a higher return on their investment, making the cost of equity more than the cost of debt. In addition to that, debt is often secured against assets. So in the event that a company doesn't repay any portion of the loan, the bank can come and repossess assets, so they have security. On the other hand, the shareholders don't have any security. If a dividend isn't paid, then you're not entitled to a dividend. You just have to accept that. And then lastly, the providers of debt capital will rank above ordinary shareholders in the case of a liquidation. So if the company is liquidated, debt providers get their money back first, and if there's anything left over, that will go to the ordinary shareholders. But if there's not anything left over, the ordinary shareholders have the biggest loss when it comes to the liquidation of a company. So you guys can see, obviously, equity providers or shareholders are exposed to much higher risk than debt providers. So equity providers or shareholders are going to expect a higher return on their investment. So the cost of equity will be higher than the cost of debt. Debt providers will be prepared to accept a lower return because they are exposed to less risk. So all of those things make debt cheaper than equity. Then in addition to that, debt is also cheaper than equity because interest is tax deductible and dividends are not. So at the end of the year when the company does their tax return, they get a tax deduction for any interest expense. So you can use the interest to reduce the amount of tax that you need to pay across to SARS. On the other hand, you do not get, or companies do not get, a tax deduction for dividends. So you can't reduce the amount of tax you need to pay across to SARS with dividends that are paid. So because debt providers are exposed to less risk, because they're exposed to less risk, they will accept a lower return on the investment. And because interest is tax deductible, debt is cheaper than equity. And that is why companies want debt in their capital structure, because it's cheaper. And because it's cheaper, they can use debt to improve returns to shareholders. However, before you all go out now and get yourselves into debt, there are obviously also disadvantages associated to having debt in your capital structure. And the disadvantage of debt finance is that interest and capital repayments must be made regardless of financial performance. So we are now looking at this from the perspective of the company. So when we looked at it from the perspective of the bank, we said because these payments have to be made regardless of financial performance, that makes it less risky for the bank because they know they are going to get their money, and if they don't get their money, there's probably assets that they can repossess. However, if we look at this from the perspective of the company, every year they have to make those interest and capital payments, and that creates financial risk for the company because there's a risk of default. So you'll see using debt finance exposes the company to financial risk. And if the company is exposed to financial risk, shareholders are going to want a higher return on their investment, because if you go back to the previous page, we saw how to calculate the shareholders' required rate of return. It's made up of business risk and financial risk. So if a company has a lot of debt in their capital structure, shareholders are going to have to be compensated for that financial risk, and it's going to cause the cost of equity or the shareholders' required rate of return to increase. So that's what I'm talking about over here. If they have debt in their capital structure, that exposes them to financial risk. So the return that is required by shareholders or the cost of equity will increase. In addition to that, the interest rate that is charged by the providers of debt capital will also increase. Because, guys, obviously, if the company is exposed to financial risk, the company is more risky. There's a risk that they won't be able to meet these interest and capital repayments. So if banks give companies loans, they are going to charge higher interest rates if the company is more risky, and they'll charge lower interest rates if companies are less risky. So if the company is more risky because of financial risk, banks are going to charge higher interest rates. So it doesn't just affect the cost of equity. Financial risk doesn't only make the cost of equity increase, it also causes the cost of debt to increase because banks perceive the company to be more risky and they then charge a higher interest rate on the loan. All right, so let's go and look at the lecture example for this section. It's lecture example 2.1. Tyrian Limited is currently financed by 200,000 Rand equity. So currently they don't have any debt in their capital structure, they only have equity finance. Profit after tax for the financial year ending 28 February 20x6 is 40,000 Rand. So that's their profit after tax for the 20x6 financial year. Tyrian Limited wants to expand by investing a further 100,000 Rand in a project with expected returns of 25,000 Rand before tax. The shareholders' required rate of return or the cost of equity, if we look at it from the company's perspective, is 18%, and the cost of debt is 12% before tax. The tax rate is 28%. All right. Now, the whole purpose of this lecture example is to illustrate the advantages and the disadvantages of debt. So what we're going to do first is let's calculate the return that the company will make from this new project. So the new project has expected returns of 25,000 Rand before tax. So your profit before interest and tax is 25,000 Rand. Then, if the project is financed using equity finance, you obviously won't have any interest expense, so there's no interest expense over there. However, if debt finance is used, we will have an interest expense. The cost of debt is 12%, and the project is 100,000 Rand. So if we want to calculate the interest, it's 100,000 multiplied by 12%, it's 12,000 Rand interest. Then you can just deduct tax at 28% to get the profit after tax, because this return over here was a return before tax. Now, before we move on, there's an important principle that I just want to highlight over here. You can see if the project is financed using equity finance, the company will have tax of 7,000 Rand. However, if debt finance is used, the company will only pay tax of 3,640 Rand. So this is one of the advantages of using debt finance. Because this interest is tax deductible, it helps companies pay less tax to SARS. And we saw that in our lecture notes. One of the benefits of debt finance is interest is tax deductible. So it decreases the tax expense or the tax that is payable to SARS. Whereas if they use equity finance, they have to pay more tax to SARS because dividends are not tax deductible. All right, so we've just calculated the return that the company will make on this new project. If we calculate the company's total return then, we were told above that for the year ending 28 February 2026, they have a profit after tax of 40,000 Rand. So that's already the profit after tax. You can then just add the return that we calculated above so that we can calculate the total return that the company is expected to make. Then let's calculate the return on investment for shareholders. So take the return that you calculated above, depending on whether equity or debt finance is used, and we are going to divide by equity. Now guys, obviously if the project is financed through equity, before this new project the company had 200,000 Rand equity and the new project is 100,000 Rand. So if it's financed through equity, equity is going to increase to 300,000 Rand. On the other hand, if it's financed through debt, your equity is going to remain at 200,000 Rand because the new 100,000 Rand is obviously financed through debt. So we are looking at the amount of equity over here. And then calculate the shareholders' return on investment. Take the return, divide by the amount of equity, and calculate their return on investment depending on whether debt or equity finance is used. All right, and we can now see the advantage of debt finance that I was talking about. This example illustrates how debt can be used to improve returns to shareholders because the ordinary shareholders would be better off financing the new project using debt as their return on investment increases to 24.68%, and they also don't need to have any further investment in the company. The investment remains at 200,000 Rand. However, if it's financed through equity, their investment increases to 300,000 Rand because they have to finance a further 100,000 Rand, and their return is lower if the project is financed through equity. If financed through debt, the shareholders make a higher return. And the reason for that is because, firstly, debt providers are exposed to less risk, so they are prepared to accept a lower return on the investment. You can see the cost of debt is less than the cost of equity because the debt providers are exposed to less risk. And in addition to that, interest is tax deductible. So because debt is cheaper than equity, we can use debt to improve returns to ordinary shareholders. However, we can't just look at the advantages of debt. We need to look at that together with the disadvantages of debt. So if we continue, however, the shareholders' required rate of return of 18% relates to business risk only, as the company was previously financed purely through equity. If you go back, guys, at the start of this question, we were told that they are currently financed by 200,000 Rand equity. So before the new investment, they don't have any debt in their capital structure. So if you go back to your lecture notes, on the first page of your lecture notes, when we are calculating the shareholders' required rate of return or the cost of equity, we take business risk and financial risk into account. So obviously, if the company is only financed through equity, then there won't be any financial risk. There's only business risk. So we have a cost of equity of 18%, but that is only compensating the shareholders for business risk because the company did not have any debt in its capital structure previously. So you need to be careful. If the company does go and finance this new project using debt finance, they won't only want a return of 18% on their investment. Their return is going to increase because they are now exposed to financial risk. So the return of 18% won't be enough anymore. So you can see that just below. If the project is financed through equity, so not debt, if it's financed through equity, then the shareholders' required rate of return will still be 18%. The cost of equity will be 18% because that covers business risk and they are financing the project using equity, so they are still not exposed to any financial risk. So the return that they want is 18%. The return that they will get is 19.33%, because it's higher than their required return, the shareholders would be happy with this. They are making a return more than their required return. However, if the project is financed using debt, the shareholders will need to be compensated for financial risk, and the cost of equity will not be 18% anymore. It will increase above 18%. So it's important to note that they should only finance this project using debt finance if the return of 24.68% is sufficient to compensate shareholders for both business risk and financial risk. It must not only compensate them for business risk, all right? Because now, obviously, if debt finance is used, they are also exposed to financial risk. The cost of equity will increase. So is this enough? Is that return enough to cover both business and financial risk? All right, and you guys can go through these important principles over here. It's just the most important principles that we addressed in that lecture example. We know that debt is cheaper than equity, so it can be used to improve returns to shareholders. We saw that in our example. However, the disadvantage of debt is it exposes the company to financial risk. All right. We then have two different capital structure theories. Now, what I want you to do, guys, this is a very simple, very easy, straightforward section. However, it will make more sense once we've actually completed this lecture. So I want you to flag this so that you remember to come back, and right at the end of the lecture, after we've covered all of our cost of capital calculations, you are then going to come back and you're going to work through this page of the lecture notes. It's very simple, but you can't work through it now. Complete the rest of this lecture before working through this section, because the discussion below will make more sense after you understand how the weighted average cost of capital is calculated.